Hey guys, it's that Dividend guy coming at you with another Motley Fool list. So today we're going to look at two top value stocks to buy right now. So I know a lot of people are dividend growth investors, but one of the really important aspects of dividend growth is the value, is the amount that you pay per share, because that determines the yield that you get and how much compounding you're going to get from that stock over time. The purchase price has a lot to do with your overall return when it comes to dividend stock. So they always say buy low, sell high. So the lower you buy a dividend stock, the higher your yield is going to be. And the higher that you buy the stock at, the lower your yield's going to be. So I always think of it like a new iPhone because it's a popular product, right? So if I'm going to buy a $500 iPhone and let's say by installing the App Store, they're going to give me 50 cents a day, but I have to pay $1,000 for the iPhone, right? I'm going to get $1,000 to get 50 cents every quarter. Not a great buy, but if I was going to purchase the iPhone anyway, it might be a good value, right? Or let's say I could buy a phone that's relatively the same, say last year's iPhone model, and they were going to pay me 32 cents a quarter for that. Well, I would rather buy the cheaper iPhone and get the 32 cents versus the more expensive iPhone and get the 50 cents. See what I mean? It's the same thing with stocks. So think of a stock how you would think of a product at a grocery store, right? Let's say you say a product I buy all the time. Say you look at Oreos, right? And say Oreos are $3.52 a pack or a package, and the knockoff brand is say $3, right? So it's not a lot more. Or let's make it a little bit cheaper. Let's say like 280, right? So 280 versus like 356. So is the is it worth it to buy the cheaper product knowing that you give away some of that quality? Sometimes it is, sometimes it's not. So that's up to you guys to determine whether or not the value is worth the the cost of the product, right? So that's something that's really important for value investors is, let's say you're looking at Google versus Facebook, right? And Google, I think, is a better company, but let's say Facebook's way cheaper. Are you, let's, you know, can you sleep at night knowing that you don't own Google and you own Facebook instead? It's kind of the same thing. It's like different products, different companies within the same sector. It's kind of like buying a name versus generic. So that's just something I do when I look at dividend stocks is I'll always look at, say, market leader like Coca-Cola and compare it to something like Pepsi or of course Dr. Pepper. I think Coca-Cola is the best one out of the three, so that's why I picked it. So two value stocks to buy right now. Let's take a look and see exactly what stocks they're talking about today. With the S&P trading at an average price to earnings ratio of 45, stocks are getting pricey, which is what happens when interest rates go down. Stock prices tend to go up, and as interest rates go up, less people like stocks. In times like these, investors might want to consider looking at value stocks like Philip Morris International, ticker symbol PM, and Dollar General, ticker symbol DG, which trade at low multiples relative to their earnings and growth potential. Let's explore the reasons why these companies offer great bangs for your buck. With a PE of 15, which is value, that's a value stock. According to Ben Graham, it's about 15 PE. The stock is valued significantly cheaper than the market average, but higher than rivals Altria and Vector Group, which trade for 10 and 14 times earnings respectively. PMI deserves its premium because it's focused on reduced risk tobacco products, which can shield it from regulatory uncertainty. According to Wall Street, Biden administration will force tobacco companies to lower nicotine levels in cigarettes. This move could push millions of smokers to quit or transition to less dangerous alternatives, like the heated tobacco system that releases nicotine through heating instead of burning. But it isn't waiting on the government to force it to make its products safer. The company is currently selling its smoke-free products in 66 countries and plans to expand to 100 countries by 2025. The FDA authorized IQOS as a modified risk tobacco product, paving the way for PMI's U.S. partner, Altria, to commercialize the system in the U.S. and pay licensing fees back to Philip Morris International. Philip Morris International expects revenue growth to grow by 5 to 7% in 2021, roughly $30.4 billion. Smoke-free products represented 28% of sales as the first quarter, and management expects to boost that to over 50% by 2025. The stock also sports a dividend yield of 4.9% and has increased its payout for 12 consecutive years. So, even though it's kind of a dying industry, they know that, and they're shifting their offerings to combat that lower rate of smoking. So, Philip Morris is honestly switching to kind of a growth perspective, in my opinion. They're at a great value right now. 15 is a value stock. They are way lower than the overall market, and they are cheaper than their rivals. Also, they are aware of the regulatory issues that might be happening due to the new president, and they are already getting to healthier options, so they have alternatives, and they are ready to take advantage of people quitting smoking and giving them an ulterior option, an alternative option, so they make that money as well. So that's phenomenal. Next, we have Dollar General. It operates in a chain discount retail store, offering consumable products, beauty supplies, and other household items. The stock is an excellent pick for value-conscious investors because it's got a relatively low multiple of 20 for its PE, and it's a consumer staple business model which helps it hold on in challenging economic environments. Like many grocery stores, Dollar General benefited immensely from the coronavirus pandemic, immensely, which led to more consumer return trips and larger basket sizes. Tailwind will likely trail off as the U.S. economy normalizes, but management believes that some positive changes in consumer behavior may become permanent. Dollar General has also expanded its market share among younger, more digitally savvy consumers, which could boost the uptick of its online ordering app. Fourth quarter sales increased roughly 18% year over year to $8.4 billion, while operating profit grew by 21% to $872 million in the period. The pandemic boosted. Management expects to see a decline due to the boost of the pandemic. Dollar General also returns value to investors through its share buyback program, repurchasing $2.5 billion worth of shares in 2020. In 2021, the board increased the authorization by $200 million, and the total of roughly $2.7 billion as of March. Dollar General does pay a quarterly dividend, although it currently has a yield of only 0.82%, with a dividend payout ratio of 13.6%, and there is plenty of room for Dollar General to cover increases in the dividend going forward. So, value stocks tend to have fewer expectations built into their valuations, making them an excellent way to reduce an arguably overvalued market. Philip Morris International and Dollar General had the added benefit operating in resilient crisis-proof industries and returning value to investors through large dividend payments and share repurchases. So they are the same side or different side of the same coin. Dollar General is more known for their share buybacks, which increases value by lowering the share count outstanding, and Philip Morris is more of a dividend increaser rather than doing share buybacks. But I believe they do share buybacks as well. Out of these two, I like Philip Morris more. I already own Altria, though. That's kind of their parent company. They're technically rivals, but Altria sells products in the U.S. Philip Morris does it in international parts of the world. So I like Dollar General better, but as an investor in love with dividends, I would definitely have to go with Philip Morris because they return their shareholders profits by increasing the dividend. But guys, these are two value stocks that could be added to your portfolio. They are both trading at a way lower sector than the overall market, and they do have dividends consistently rising, room to grow those dividends, and they could give you pretty decent returns over the long term, especially because they both performed better in the pandemic, which is kind of funny. A lot of companies have gone under and had massive dividend cuts or profitability issues during the pandemic. So these two companies have definitely held strong in that hard time. So guys, let me know if you own either one of these stocks or maybe own a competitor like I do. I do own 152 shares of Altria Group. So with that being said, guys, thank you so much for watching. Remember to hit the subscribe button, and when you do, hit the bell notification so you don't miss any updates. I post 2 videos every single day, a Robinhood portfolio video and a list or some other type of video just for fun. Thank you guys so much for watching. Remember to hit subscribe, and I'll see you guys tomorrow with another video. Take care.